Welcome to this explainer of Microsoft's Q3 fiscal year 2026 earnings release. I'm absolutely thrilled to be your host today as we break down what is, quite frankly, a stunning quarter. Today, we're going to look at this through the lens of a professional analyst briefing geared specifically for institutional stakeholders. We'll be examining the massive, really material impacts of artificial intelligence and cloud computing on Microsoft's top-line revenue. To truly appreciate these numbers, we kind of have to zoom out and look at the broader macroeconomic environment. Right now, the entire tech sector is literally obsessed with this AI arms race. We're talking about hundreds of billions of dollars in capital expenditure being deployed globally. And the big question on everyone's mind is, where is the actual return on that investment? Well, we've got a lot of fascinating data to unpack from their latest press release, and the numbers we're about to dive into tell an incredibly compelling story about the current state of enterprise technology and, more importantly, who is actually winning this race.
But real quick, before we jump into the deep end of our analysis, please note that this video is for educational purposes and not financial advice. We're just here to strictly analyze the data reported by Microsoft and understand the underlying mechanics of their business growth.
All right, let's dive right into this executive briefing. We're going to be covering 1. The executive summary and top line. 2. Azure and cloud growth. 3. How AI infrastructure drives success. 4. Returning capital to shareholders. And finally, number 5. Operational risks and uncertainties. Let's get right to it.
Starting off with Section 1, Executive Summary and Top Line. Okay, so we're going to take a really clear, high-level look at Microsoft's sweeping revenue beat for the quarter ended March 31st, 2026. The absolutely crucial point here is the sheer scale we're dealing with. Total revenue came in at an eye-watering $82.9 billion. I mean, for a company of Microsoft's immense maturity and size to report an 18% increase in top-line revenue, that is simply phenomenal. But it's not just top-line fluff, right? Operating income hit $38.4 billion. That's a 20% increase. And when we look at actual profitability for shareholders, we see a massive 23% jump in GAAP diluted earnings per share, bringing it to $4.27. Now, if you're an institutional stakeholder, when you see revenue growing by 18% and EPS growing by 23%, you are looking at the holy grail for a mega-cap tech stock. It demonstrates incredible operational leverage. In really simple terms, it means their costs aren't scaling as fast as their profits. The business is actually becoming significantly more profitable as it expands, which is honestly incredibly rare to see during such a heavy capital expenditure cycle.
So when we break down that $82.9 billion, you can see Microsoft is effectively standing on two massive, nearly equal pillars of strength. First, you've got productivity and business processes, so think your Office suite, Dynamics, and LinkedIn. That generated $35.0 billion, up 17%. Right beside it, the Intelligent Cloud segment generated $34.7 billion, which is up an incredible 30%. Meanwhile, the more personal computing segment, which includes things like Windows OEM and Xbox, remains relatively flat at $13.2 billion, actually decreasing by about 1%. The story here is just incredibly clear. The enterprise side of the house is doing the heavy lifting. The relatively flat consumer and hardware numbers reflect some of those post-pandemic slumps and cyclical gaming trends, but honestly, they are entirely overshadowed by the sticky, recurring revenue of those enterprise pillars. You have to remember, companies don't just easily cancel their enterprise software or their cloud hosting during an economic tightening. That makes those two main pillars incredibly resilient.
Moving on to Section 2, Azure and Cloud Growth.
Now, looking at the specific performance of Microsoft's cloud segment, we see an absolutely explosive 40% growth in Azure and other cloud services revenue. Remember, the total company revenue grew at 18%. Intelligent Cloud as a whole grew at 30%. But Azure itself? It is growing at 40%. Maintaining a 40% growth rate at this kind of massive scale effectively defies the law of large numbers. And that is exactly what institutional analysts look for. This metric significantly outpaces the broader company growth and acts as the true locomotive pulling the rest of the earnings train. For any analysts out there modeling future cash flows, this 40% figure is your absolute anchor. It shows that institutional demand isn't just steady, it's accelerating.
But, we don't just want to look at what happened in the past 3 months, right? We need to look at the pipeline. By contrasting the $54.5 billion in immediate quarterly Microsoft Cloud revenue, which was up 29%, against a staggering $627 billion in commercial remaining performance obligations, we can clearly see the future. Let that sink in. A $627 billion figure. That represents a 99% year-over-year increase. For stakeholders, remaining performance obligation just means contracted committed revenue that simply hasn't been recognized on the income statement quite yet. A 99% jump means they have secured a massive long-term contractual pipeline. Enterprises aren't just buying cloud services for today, they're locking in massive multi-year contracts for the future. That $627 billion backlog acts as an almost impenetrable financial moat. It essentially recession-proofs the company's near-term future, giving stakeholders immense rock-solid predictability in an otherwise volatile macroeconomic landscape.
That brings us to Section 3. AI infrastructure drives success.
So what exactly is the primary underlying catalyst driving this overall enterprise success? What's causing this huge jump in performance obligations and this crazy cloud momentum? The answer is AI infrastructure. It's clearly represented by this breathtaking 123% year-over-year revenue growth in their AI business. This is the halo effect in action, folks. Companies are rushing to Microsoft to build, deploy, and scale artificial intelligence. And doing that requires immense computing power, massive storage, and complex data services, which in turn fuels the Azure growth we literally just talked about. It's a compounding loop. Customers who come for the AI compute inevitably end up buying cybersecurity protocols, Office 365 integrations, and basic storage as well. Seeing 123% growth at this scale absolutely proves that AI adoption is happening at an unprecedented velocity in the enterprise sector. And Microsoft? They're capturing a massive share of that wallet.
CEO Satya Nadella framed this data perfectly in the earnings release. He stated, "Our AI business surpassed an annual revenue run rate of $37 billion, up 123% year over year, empowering every business to evaluate their outcomes in the agentic computing era." Now, evaluate is a bit of corporate shorthand for evaluating and maximizing business workflows. It means AI is actively being used to optimize core business operations. This confirms that AI is no longer just some abstract R&D project or a distant, futuristic concept. No, it is a massive, tangible $37 billion annual run rate engine lifting the entire enterprise ecosystem. Furthermore, his mention of the agentic computing era is absolutely critical to understand. We are moving away from AI that simply answers questions like a basic chatbot to AI functioning as an autonomous agent that can actually take actions and execute complex, multi-step workflows. This kind of computing requires significantly more power, which locks clients even further into that Azure ecosystem.
Now for Section 4, returning capital to shareholders.
As institutional stakeholders, you obviously need to know how you're being rewarded for this unprecedented velocity in AI and cloud growth. Growth is great, sure, but capital discipline is what actually sustains long-term investor confidence. Well, Microsoft returned an impressive $10.2 billion to shareholders this quarter in the form of dividends and share repurchases. Now, think about why this matters so much to Wall Street right now. Many tech companies are currently out there burning massive amounts of cash on AI with zero near-term returns in sight. Microsoft, on the other hand, is investing tens of billions of dollars in massive capital expenditures to build out their data centers and buy the GPUs necessary to support that 123% AI growth, while simultaneously generating free cash flow so incredibly strong that they can still afford to hand $10.2 billion right back to investors in a single quarter. This demonstrates incredible, almost unheard of financial health. It's the core thesis of their financial strength, an unyielding commitment to shareholder returns operating right alongside heavy, future-proofing infrastructure investments.
Finally, Section 5, operational risks and uncertainties.
To maintain our analytical rigor as we evaluate all this reporting, we have to seamlessly transition from the revenue beats to a forward-looking reality check. A proper analyst briefing requires us to look at what could actually go wrong, and to their credit, the earnings report explicitly flags several key market uncertainties. First, the intense focus on cloud and AI services presents significant execution and competitive risks. Google and Amazon Web Services are certainly not standing still. This is a fiercely contested market. Second, they highlight cyber attacks and security vulnerabilities, which, let's face it, is a constant, compounding threat when you are hosting the world's most sensitive enterprise data. Third, there are evolving legal liabilities and reputational risks regarding how AI is actually used by customers. This includes things like copyright infringement and data privacy concerns. This is becoming a massive headache for institutional compliance teams. And lastly, there's the risk of excessive outages or data losses if they fail to maintain their operations infrastructure. When you're growing Azure at 40% and AI at 123%, the physical server infrastructure is being pushed to its absolute limits, making the risk of catastrophic outages a very real concern that must be carefully weighed by investors.
So as we wrap up this explainer, we have to look at all this staggering data. The $82.9 billion revenue.
the $627 billion contracted pipeline, the 123% AI growth. And we must ask this provocative question. Are AI infrastructure moats actually sustainable in the agentic computing era? Microsoft has clearly captured the early lead and they are printing cash right now, but we've got to watch carefully to see just how long these immense AI-driven growth margins can be defended against intense market competition in the coming years. Honestly, it is the multi-billion-dollar question for every single stakeholder involved.
Thank you so much for joining me to break down this truly remarkable quarter. If you found this professional analyst briefing valuable, please like and subscribe for more videos. I really look forward to diving into the data with you again soon.